Okay, good morning, everybody. Happy New Year.
Good morning,
everyone. Roll call.
Chair,
Here.
Controller's Office,
Larry.
Public Advocate's Office.
Sorry, I'm here.
You're sorry you're here, Larry?
Public
Maybe not
Advocate's
now, but
Office.
after you.
Borough President Manhattan,
Here.
Borough President Brooklyn.
Here.
Borough President Queens, Borough President Staten Island,
Present.
Borough President Bronx,
Here.
International Brotherhood of Teamsters,
Here.
Transport Workers Union,
Here.
District Council 37.
Here.
We have a quorum.
Okay. Larry, over to you.
Okay. I'm going to dispense with our going through the economic charts because next month we're going to bring in an economist from one of our money managers, so they'll go through the whole dog and pony show. Let's just put it in a simple sentence and say, ex-Europe, I would say that the U.S. economy is slowly working its way up. Europe seems to be fine for the last 2 weeks. Stay tuned as to what happens in the future. But in general, it's consistent with what we said before, slow, gradual recovery. Emphasis on the word gradual. That'll get you in this book to page 21.
Well,
Which is the chart of the VIX. The big 21 in the middle of the circle. The VIX, as we all know, is a measurement of volatility in the U.S. public equity market. It's below 20 now. That's reasonably calm, particularly calm since August. It's a sigh of relief because the EU decided to make 3-year loans available to all the banks in Europe. They've all bought $300+ billion taken loans, and what those lenders, the banks, have done with that capital, which is very, very low cost, is they've gone out and buy new issued government bonds, so the rates in Spain, Italy are off the peak, and things are calming down. That's today. Not to say that's going to continue, but that is the primary reason that the VIX has gone down. If you go on page 22, the white line is the yield curve of U.S. Treasuries. Again, continues going down. It's the Fed's Operation Twist. It's successful. Rates are going to go down. The Fed's going to talk perhaps today or tomorrow about their longer-term view, but the general consensus is down and keep it down. You can see that on the next page, 23, U.S. Treasury 10-year. It's hovered when there's a panic around 185 to 190. Excuse me. In the last 3 days, it's gone back all the way up to about 206, 207. Again, makes people sell their treasuries and go to riskier assets. 24, you can see, again, high yield spreads and investment grade spreads backed up. They're in the process of coming down. But again, this is all moment to moment. You may recall last year, a long time ago in 2011, every day was a risk on, risk off day. People have been pretty relaxed so far this year, but again, this is, I think, the third week of the year, so we shouldn't declare victory quite yet. Just thumping ahead. If you look on page 29, you can see the stock market indices, U.S., EFA, and emerging markets. I draw your attention to the white line, which is the U.S. stock market, which again, as the VIX went down, people started to feel better this year. So again, 3 weeks, 4 weeks. The stock market has gone up. EFA has kind of bounced around because it's more dependent on international flows, and risk is kind of a little more back on in emerging markets. So January, these are November numbers we're going to go through, but January so far is a very good month. If you look on page 31, how's NYCERS done? This is the last 12 months. In November, it's about 39 billion. My guesstimate is by December 31st, it'll be closer to 40-ish, and probably 240 in January, the way things are going. You can see on page 32 how it's done over 10 years. Again, these numbers are net of $1.6 billion coming out a year. Recall that we're going from page 33 to page 34 in our asset allocation. If you look on 34, this is kind of the map that we're going. At the end of November, we had 5.8% in cash. Since that, we're down to about 4%, plus or minus, actually plus a little. The delta is we added 1% to high yield in December. We funded a half of 1% into hedge funds. So the combination of taking 1.5 off gets you to about 4.2%. We're continuing to fund some of our opportunistic fixed income managers in January. And we'll probably fund another hedge fund investment in the future. That'll get us down to the low 3%. With some other things in the hopper going forward as well. So if I would look at the asset allocation chart, the pluses and minuses, I draw your attention to the blue box, which is the fourth one, which is hedge funds. Again, we're starting from our Pramal and we're working our way up, so that's in process. The chartreuse one, I think the second from the right, is the opportunistic fixed income. Mark was diligently working on documenting it, but it's taking longer than we thought. Again, about half of that has been allocated to people. We just haven't been able to finish the documentation on some of it, but a couple of them are being funded now. And the one that says 0.3, which is high yield, again, we added 1%, so that's now 1.3%. You can see the numbers on the next page, 35. If you go to page 36, you can see how the markets behaved in November. U.S. stock market bounced around, but didn't end very much. It was more action internationally in the EFA and emerging markets that were down 5%, which we're going to get to show you what that did to our results. But basically, November wasn't a very good month. December was better, but still was sort of plus or minus about the same, maybe up a little. But for January, this is going to be a good month. You can see December, the next page, 37. Again, the minuses in the international are offset by the pluses below that in the fixed income securities, which more than offset the minuses on the international side. So December will be a positive month. If you look on 38, so for the month of November, we were down 1.25%. Brings our year-to-date down about 5. I think we're probably up 1-ish, let's say, in December, so we're down 4 halfway through the year, and we probably made 2 or 3% so far in January. So we're close to getting back to break even for the year, and we always remain optimistic but cautious. So we'll see where June 30 ends up. But I would say for end of December, we're probably down 4-ish for the 6 months, and we'll probably make a couple extra percent in January so far. And again, you can see the losses are primarily in the equity side on the far left. The rest of the managers are kind of holding together pretty well. Some are plus, some are minus, but no one has really fallen completely out of bed. Mark, do you have any comments on fixed income? Seema, anything on equities overall?
No.
No. So if anyone has any questions, we're happy to talk about it. Otherwise, that concludes our overview of the month of November.
Well, Larry, I want to ask you about, maybe this is not your expertise, but the consumer sentiment page 9. That seems to be on a very upward trajectory, but it doesn't seem to be translating into retail sales or home sales. What's happening? People are feeling good, but they're still not spending money, or?
Well, I would say the consumer sentiment is sort of non-scientific. Take a survey of 2,000 people and say, how you feeling good or bad? So it's very reactionary to headlines. So if you look back in September, we called it August, everything was falling apart, so they felt bad. So things aren't falling apart quite as much as before. They're feeling better. Jobs are stabilizing. Unemployment or new claims is coming down ever so slowly, but coming down, so people are feeling a little better. That doesn't mean they invest anything. It just means they feel better. Because you can see the rest of the slides are, again, trending up, but ever so slightly. So this is going to be a long slog.
Sure.
What's your view of Europe?
I think that this move of giving the banks the $350 billion of access is a very good move. It's 3-year money. So with 3-year money and very low rate, and they can invest that in government securities, they pay a higher rate, so it drives prices down, right? Drives prices up and yields down. And it comes at a time when Italy in particular has to do a lot of refinancing in the first quarter, which they would then be saddled with for the next 5, 10, 15 years. So if you can force that rate down, that some of these European countries have to refinance without them buying it directly, then the EU, the ECB, they've actually been pretty creative. For all the grandstanding it does, you're pretty creative. You also set up a program that you don't have to have everybody hanging on the edge of their seat with eventually do it. 3 years being long enough out there that people can forget about it. You create earnings, right? You create earnings at the banks, so you're re-equitizing the banks. And at some point, the banks get comfortable. Now, having said that, there's a lot of pressure on the banks to lend, because at some point you got to recycle that back to the economy. It doesn't solve everything at all, but it's a good step. Again, Europe is not a country. They all have different elections. You've seen all this turnover of presidents. They're all in different places. But as far as action, which is one of the problems, real concrete action, I would say this was good concrete action. More problems to come.
The only reason I ask is the last 2 days of Bloomberg Radio, which I listened to more. It's just been absolutely incredibly pessimistic about Europe. Basically saying it's not going to work. I have no idea.
I don't know. They're all sitting there in Switzerland. Must be all right. They're confident. But I don't know. I think, again, it's relative, right?
But if it doesn't work,
Well, I would just look back at the last 5 months, right? Anytime something looks like, forget blow up, anything there's a bad bend in the road or a little bump in the road, everybody flocks back into U.S. Treasuries, risk is off, stock market goes down, it's the end of the world. Just don't want, I can't buy that as the long-term answer. Okay? So there's a lot of muddling going on, kick the can down the road and all that kind of stuff. There are problems, right? Greece, they can, they're trying to get a big discount, but, at the end of the day, they are going to get a big discount. So they will have wiped off hundreds, tens of billions of dollars of debt. That's good. The problem is, okay, so you have 2 problems, right? You have your debt, and you have your growth of your economy. So the pessimism, I would tell you, is, well, you can't cut your way out of this. So you can try to get the debt under control, which is financial engineering. But ultimately, you've got to put people back to work. Same problem we have. You've got to put people back to work. And you cannot put people back to work by cutting your budget. And so if you look at Italy and Greece, so you have, all right, we're now in charge, we're going to deal with our debt. Try to. But then we're going to come up with austerity. That doesn't work. So, again, how do I feel for the next little bit? I feel better than I did before. Again, this is not a straight line. It's going to be a bumpy road. Settlement will go back, sentiment will go back and forth with every news event like it has the last 5 months. But I would say it's a good step forward. Not a game saver. But, it's not, I personally don't believe that the euro is going to go away. So once you get over that, you can argue about the exchange rate should be worse and this and that, but I just don't think that they have the will or to see it blow. They can fix that. But don't forget, to fix it, someone's writing checks. It does take money. So the Germans are fine. And that's a political problem. Someone's got to pay for that. So let's go around and around. It's very, very complicated stuff that no one's actually had to deal with before. So you can't look at history. You can, but it's very complicated. I have these analogies to history that everybody likes to always have. Because it has a currency like the euro. Having said all that, And, you know, you are going to have a recession. You know, people are saying, well, you're going to recession or not. I bet you it does. Why wouldn't business company? So there's a transformation going on that like in business, it could take years. You know, we tend to watch this monthly, but people tend to trade the securities minute by minute. So it's microscopic. It's a good time to be a long-term investor if you get things right, the long-term things right. So, but bumping ups and downs. I feel pretty good actually about where we are now. I've just gone through 6 months of bumping to come out sort of down 4-ish%. That feels all right. So, again, if I take it back to this, all the stuff we're trying to do is take volatility out and figure out how to make more money with volatility. Right after the 15 picture.
Right.
That's what we're trying to do. It just takes us time to get the tanker turned around. Also, you know, pessimists and spreads. So it's interesting. Your question is the exact opposite of ours. I'll say, why is Michigan saying that the U.S. consumer is happy, they're feeling better, and the guys in Davos are sad? Don't forget, some of the guys in Davos are banks.
Well, that seems to be the issue.
Right.
That's what they're going to give a haircut. They want the banks to take a haircut and not the sovereign holders of the Greek debt.
Correct.
And so that
And the lower interest rate. So
right. And so
Government.
there's some threat of litigation.
It's a negotiation. You know how it works.
calling it a human rights violation. In Europe, property rights violation is a human rights violation. Fascinating.
I don't know.
Oh, but you know the dynamics of the work. That's what they got going on. Just always walk away, storm, throw your arms up and down. Right?
Yeah.
Then everyone takes the weekend off, gets back together. Right? So that's what they're doing. Right. Anyway, stay tuned.
Martin wants to say something.
Brief thing, Larry. This Larry over here.
Both of us, we said this.
I think a key metric that we look at is one of the more obscure metrics potentially, but a lot of people on the street look at it, which is the bid to cover ratio. A lot of the sovereign debt auctions will have occurred recently and will need to occur because there's a lot of refinancings coming and there's a lot of new debt that needs to be issued. Earlier, or I should say later last year, there was a certain amount of debt that sovereigns wished to raise, and they weren't able to raise it because there wasn't enough demand because of uncertainty. And the bid to cover ratio, meaning the amount of investors willing to invest, was very low compared to the amount that was out there. In the most recent auctions, for instance, in the Italian auction where the 10-year was trading at about 7%, the bid to cover ratio went from 1.2 from the prior auction, I believe, to over 2%. I'm sorry, to over 2 to 1. So it's an indication that investors are actually willing to step in and buy the debt. And so that's actually a very good sign. Moreover, because the bid to cover ratio was so higher than they expected, they actually issued more debt than they wanted to, so it pushed out or moved out the amount that they had to raise overall later in the year. So overall, that for now, it's a good sign.
But understand where the buying power came from ECB lending to banks.
Yes.
Cheap money. As opposed to the ECB buying it, they said, no, we'd rather have the lenders, our borrowers be banks. We have to pump the banks up.
Your remarks, Martin, are confined to Europe and sovereign debt?
Yeah, so compared to the U.S., just as an example, the bid to cover ratio is usually several times that.
Meaning more people want to buy it than what's available.
But of course, also in the U.S., you have effectively the Fed with Operation Twist buying up all of the available debt that's out there for auction. Although, having said that, there's huge demand from it because of the risk on, risk off.
Well, they returned $75 billion in profits to the Treasury last year. So people have likened our Fed to the the greatest, biggest hedge fund in the world. They're borrowing cheap, levering up, investing in high-yielding assets.
I have a little bit of inside information. Anything else? That concludes the November numbers. That's it.
Public session?
That's it for public session.
Okay, can I get a motion to move out of?
If you recall, you took a vote to re-up on the carbon disclosure project, so we just need to ratify that vote in public session. So the vote was, I think it was unanimous, so we're just going to ratify the vote in public session that you agreed to sign on to the carbon disclosure project for one more year?
Yes, I will.
For one more year.
Any opposition? Seeing none?
Thank you.
So motion to move into executive session? Second? Any opposed? You're in executive session? Did Inga want to do?
We turned off?
Fine.
It turned off.